G'day, Gain Squad! Let's see where the smart money is flowing today as we pull back the curtain on the biggest heist in history. Jump up and under, let's get into it. We're talking about a man who turned Wall Street into his own personal ATM. Today we're dissecting the Bernie Madoff scandal, from his humble lifeguard starts to that infamous 17th-floor secret operation in New York. We'll expose the mechanics of the 703 account, the fake audits, and why the SEC missed the red flags for 16 years. Then, we're comparing that $65 billion crash to the 2026 AI bubble to see if we're standing on a digital trapdoor. Real quick before we dive in, this is all for education and entertainment, not financial advice, so be careful who you trust with your gains. So here is the big question for the comments. Do you think the current AI boom is a genuine revolution or just Madoff 2.0? If you want to stay ahead of the curve, smash that like button, subscribe to join the gold getters, and let's optimize this entry. Bernie Madoff wasn't always a high flyer. He started in 1960 with just $5,000 from lifeguarding and installing sprinklers. He built a legitimate brokerage that actually helped create the tech behind the NASDAQ, giving him massive street cred in the industry. By the 1980s, he was the NASDAQ chairman, a proper big wheel who everyone trusted with their life savings and retirement funds. But while the world saw a pioneer, Bernie was running a side hustle that would eventually incinerate $65 billion of global wealth. He cultivated an air of exclusivity, making it a mark of prestige to be accepted as an investor in his private fund. If you were in with Madoff, you were part of the elite, which is exactly how he kept the smart money from asking too many questions. He was the first big practitioner of payment for order flow, basically getting a legal kickback for executing trades, which added to his legend. The real magic happened in the Lipstick Building on Manhattan's 3rd Avenue, but not on the floors everyone could see. The 18th and 19th floors were legitimate trading hubs run by his sons, but the 17th floor was a different story entirely. This was the hedge fund division, where less than 24 people worked in a sequestered, low-tech environment away from prying eyes. While the floors above were high-tech, the 17th floor used old computers to churn out thousands of fake monthly statements for clients. Bernie's strategy was called split strike conversion, a fancy term used to promise 10% returns every single year without fail. He claimed to buy blue-chip stocks and protect them with options, but in reality, he wasn't buying or selling a single thing for clients. The 17th floor was essentially a document factory, designed to maintain the illusion of a perfect, volatility-free investment machine. Every single cent of investor money was funneled into a standard business account at Chase Manhattan known as the 703 account. Instead of being invested in the market, your cash just sat there until another investor wanted to withdraw their profits. Madoff used the deposits from new gold getters to pay off the old ones, which is the textbook definition of a Ponzi scheme. He relied on the balance of this 703 account staying high enough to meet all the withdrawal requests coming in. By November 28, the account was hitting dangerous levels as new investments totaled only $300 million. At the same time, panicked customers were trying to withdraw $320 million, leaving him nearly bone dry. To keep the lights on, his London office had to wire $164 million back to the US firm just to stay afloat. The profits on the statements were total fabrications. Harry Markopolos later estimated $35 billion of it never actually existed. Madoff even charged zero investment fees to make the returns look even better, which is a massive red flag in any professional fund. The scheme only survived as long as the 703 account stayed liquid, but the global financial crisis was about to end the party. One of the biggest oh-no moments was his auditor, Freeling and Horowitz, which was just a tiny 3-person shop in a suburb. David Freeling was the only active accountant, and he was supposed to be auditing a multi-billion-dollar operation by himself. Madoff paid him between $12,000 and $14,500 a month to essentially rubber stamp the books. Freeling never verified a single asset or checked if the stocks Madoff claimed to own actually existed with a third-party custodian. He wasn't even registered with the Public Company Accounting Oversight Board, which is mandatory for detecting this kind of fraud. Because Madoff acted as his own broker and custodian, there was no independent check to prove the money was actually there. Freeling later admitted he just signed whatever Madoff's team put in front of him, deceiving regulators for nearly 20 years. It was a complete breakdown of governance that allowed $65 billion to vanish without a single alarm bell ringing. This shows that if the auditor looks too small for the fund, the regulators just move on and carry on. The SEC investigated Madoff multiple times between 1992 and 2008, but never found the smoking gun. Harry Markopolos, a mathematical genius, sent the SEC detailed reports proving Madoff's returns were a physical impossibility. He told them Bernie would have to buy more options than actually existed in the world to make his strategy work, but he was ignored. A lawyer named Genevieve Walker-Lightfoot found inconsistencies in 2004, but her bosses told her to stop the investigation. It didn't help that Madoff's niece, Shana, married an SEC official named Eric Swanson, creating a massive perceived conflict of interest. Madoff's high-profile status and his role at the Nasdaq acted as a credibility shield that made regulators hesitate to dig deeper. He even told the SEC's Inspector General later that he could have been caught as early as 2003 if they'd just checked the trades. They were so focused on front-running and technical violations that they missed the massive $65 billion hole in the middle. The victim list was a who's who of the rich and famous, showing that even the pros can get blinded by the promise of easy money. Hollywood mogul Steven Spielberg's foundation took a massive hit, and actors Kevin Bacon and Kyra Sedgwick lost millions. Nobel laureate Elie Wiesel lost his entire life savings plus $15 million from his foundation, calling Madoff a scoundrel. Broadcaster Larry King and New York Mets owner Fred Wilpon were also on the list, with Wilpon taking a $500 million hit. It wasn't just individuals. Massive banks like Banco Santander and HSBC were exposed through feeder funds that funneled cash to Bernie. These feeder funds bundled money from smaller investors who often had no idea their capital was sitting in Bernie's 703 account. The prestige of being a Madoff investor was so strong that people literally begged him to take their money at country clubs. This is a classic affinity fraud, where the con artist targets their own community to build a wall of trust that's hard to break. When the tide went out in 2008, these famous smart money investors realised they had been swimming without their trunks on. Aussie investors weren't immune either. We had our own mini Madoff drama with the collapse of Trio Capital and Absolute Alpha. While the scale was smaller, Trio Capital involved the disappearance of hundreds of millions of dollars into offshore hedge funds. Many Aussie self-managed super funds were caught out, proving that prestige investments often hide a lack of transparency. Australian regulators like ASIC have since banned several advisors for switching clients into flawed schemes like the Shield Master Fund. Even the big four banks, CBA, NAB, ANZ and Westpac, have had to tighten up, recently exiting thousands of suspected mule accounts. ANZ even faced a $240 million penalty for widespread misconduct, showing that governance is a constant struggle. The lesson for us traders is that if a fund doesn't have an independent custodian in Australia, it's a no-go for the smart money. Always check if the person managing the money is also the one certifying the statements. That's where the trouble starts. Warren Buffett famously said that you only find out who's swimming naked when the tide goes out, and 2008 was a very low tide. Ray Dalio from Bridgewater Associates stayed clear because he couldn't replicate the returns using his radical transparency model. Dalio's all-weather strategy is built to be indifferent to economic surprises, whereas Madoff's was built on the lie that surprises don't exist. Dalio believes that if you sit down at a poker table and don't know who the sucker is, then you're the sucker. Jim Cramer admitted his view of the market was forever rocked by the realization that a Nasdaq chairman could be a crook. These legends teach us that unusually consistent returns are actually the biggest warning sign you can find in any market. The collapse finally hit on December 10th, 2008, when redemptions reached $7 billion and the cash was gone. Madoff confessed to his sons, Mark and Andrew, telling them the entire asset management business was one big lie. The brothers acted immediately on legal advice and reported their father to the feds before the sun even came up. Bernie was arrested the next morning, and the news sent a shockwave through the financial world that is still felt today. The consequences for the family were devastating. Bernie was sentenced to 150 years in a federal prison cell. His son Mark tragically took his own life on the second anniversary of the arrest, unable to bear the shame and legal pressure. Andrew Madoff died from a recurrence of lymphoma in 2014, blaming the unbearable stress of his father's crimes. Bernie himself died in prison in 2021 at the age of 82, leaving behind thousands of ruined lives. While authorities eventually recovered about $14 billion, the emotional and financial scars on the victims remain deep. Now traders, let's pivot to 13 April 2026 and the absolute mania surrounding agentic AI infrastructure. We're seeing a circular money machine where big tech firms are investing billions into AI startups like OpenAI and Anthropic. These startups then take that investment and spend it right back on the cloud services and chips provided by the same big tech firms. It creates an illusion of growth, where capital moves in a circle, inflating valuations while real consumer revenue is still tiny. In 2026, we are spending over $500 billion on infrastructure, but only seeing $12 billion in actual revenue. That is a 42-to-1 ratio of investment to returns, which is actually worse than the dot-com bubble at its peak. We are also seeing AI vaporware, like startups valued at $30 billion with no public product and zero customers. Investors are pouring cash into pitch decks because of a founder's reputation, exactly like people did with Bernie Madoff. Ilya Sutskever's new company, SSI, hit a $30 billion valuation in March 2025 without a single cent of revenue yet. If these massive investments in data centers don't lead to profitable products soon, we are looking at a systemic valuation reset. The DeepSeek shock of late 2025 proved you might not even need the $100 billion clusters everyone is building. This could turn billions of dollars in hardware into stranded assets, which is the 2026 version of a 17th floor empty vault. Smart money is starting to worry. A Bank of America survey shows 23% of credit investors fear an AI bubble. We are seeing AI washing everywhere, with companies slapping an AI label on everything just to pump their stock price before the close. SEC Chairman Atkins has warned that AI washing is a top enforcement target for 2026 reporting seasons. If you can't show a measurable return on investment from your AI spend, the market is going to penalise you hard this year. Only 6% of firms are currently AI high performers, seeing a real boost to their bottom line from these tools. The rest are just caught in pilot purgatory, paying for expensive software that doesn't actually improve productivity yet. Don't let the hype distract you from the cash flow. If the math doesn't work, it's just another castle in the air. To protect your pouch, you need to verify if a company's revenue is coming from real customers or just circular financing. Scrutinize those AI roadmaps and make sure they aren't just a smokescreen for a stagnant core business model. Use the Markopoulos test. If the growth seems too perfect and the moat is just hype, you might want to exit. Diversify your holdings into value stocks or international markets to avoid the concentration risk in the big tech titans. Remember that high returns always come with higher risk, no matter how charming the CEO or how revolutionary the tech is. Keep your bull meter calibrated, and don't be afraid to walk away from an entry that feels too mysterious or exclusive. Let's optimize this entry by looking at the technicals for the S&P 500, currently at 6,816, as the market pivots toward the next phase of the AI growth cycle. The market is aggressively pricing in the dominance of AI giants like Nvidia, Microsoft, and Alphabet, with the 6,850 resistance level acting as a major pivot for these high-weight tech stocks. If these leaders hold above this zone, smart money expects a push towards 6,900, driven by massive enterprise spend on models from OpenAI and Anthropic. The Nasdaq is currently sitting at 21,800, showing decent relative strength as capital flows into NVDA's hardware and the cloud infrastructure of MSFT and GOOG. We are seeing a neutral relative strength index, RSI, in the mid-50s, meaning the big three and their ecosystem aren't overbought just yet, despite the recent valuation surges. The volatility index, FIX, is at 23, which means things are getting a little spicy. Volatility is rising as investors weigh the massive R&D burn of OpenAI and Anthropic against actual revenue gains. For the Euro-USD pair, we're seeing the US dollar bid return. This strengthening dollar could impact the international margins of GOOG and MSFT as crude oil prices surge again. This is a proper golden entry if you are looking for stability in high-quality AI leaders with massive balance sheets rather than chasing unproven, high-multiple hype. Today could look a lot more like 2008 than we care to admit. There will always be another Bernie Madoff, Sam Bankman-SBF, or swindler ready to steal easy money. Always be careful where you hold your funds and who you trust. Do your due diligence and don't buy into the hype at face value. The smart money is only as smart as the weakest link. The SEC is still run by real people with their own agendas, and the US markets will always have a level of unpredictability. Investor funds stayed in a single brokerage account for almost 20 years without raising any concerns at some of the biggest institutions on Wall Street. Diversify your holdings into boring assets such as gold, bonds, and simple stocks that aren't involved in the AI bubble. Control your exposure to a single fund, investment, or market trend. And most importantly, subscribe to learn from the past. Don't repeat the same mistakes. What's your take? Is the AI boom the future of the global economy, or the world's first trillion-dollar Ponzi scheme? Drop a comment below with your thoughts. I want to see what the Gain Squad is thinking about this bubble. If this video was a ripper, hit that like button and subscribe to Goldie Gains for more deep dives into the smart money. Keep your positions tight, and Gains Golden, I'll see you at the next close. Cheers.